If you want to gain insight into an economy, look at its banks. Loan growth tends to be tied to economic growth, and banks are essentially investment plays on their underlying economies. This is because credit is the lifeblood of an economy. It wasn't flowing for some time following the financial crisis, but things have since progressed. And credit demand and loans have picked up in certain areas, but not in others. With that, we thought we'd get an update on lending from the ground level. Joining me now is Jay O'Brien, Executive Vice President of Commercial and Retail Banking for Sandy Spring Bank. We should note that Sandy Spring Bank is the exclusive sponsor of this program. Mr. O'Brien, welcome to the Wall Street Report. So great to have you on the program.
Thank you. It's great to be here.
So tell me, how is business?
Business, I think anyone in business in 2012, it's kind of a relative answer. Tough economy, if you're a bank, tough regulatory environment, difficult interest rate environment, but I'm happy to say business is good. We're doing very well. We have organic loan growth back, as you alluded to. Our production of really low-cost deposits is terrific. Our wealth management, mortgage businesses are doing well, and fortunately we have plenty of capital to support that growth. So overall, it's good.
What's your outlook for the economy from your vantage point?
Yeah, we're projecting only slow to no growth really in the year ahead. Similar to this year, we don't really see those drivers of big economic activity that would drive more growth than what we've seen. For us, the risks out there are more significant than the upside potential, and those would include the fiscal cliff talk, changes to the tax laws, changing laws as it relates to health care.
What are you seeing now in terms of demand for loans, both on the consumer side and the commercial side? You mentioned the fiscal cliff, and we keep hearing that businesses are holding back from investing and expanding because of this fiscal cliff. What are you seeing now?
Yeah, I think that's absolutely the case. I mean, even though none of us knows how that's going to end, the specter of it is causing many to pull back. It's been interesting. Early in the year, both on the consumer and the commercial side, we saw pretty robust demand for the normal drivers. There were businesses borrowing for equipment or buying that truck they were holding off purchasing. Consumers as well, some more borrowing on equity lines and things of that nature. But it was interesting, in June or so of this year, all those things that I mentioned created a real lack of certainty in business, a lack of confidence. And loan demand has really waned as it relates to those normal drivers of economic growth. Many of our clients have been, they're very profitable, they've got their expense levels pretty much where they want them, but they don't have that confidence to hire or to expand their business and therefore not borrow. They'd rather pay down debt.
So then what is your outlook for loan growth as we get into the last couple months of the year and then into 2013?
Yeah, we've been tracking on mid to high single-digit loan growth. For next year, we're expecting a little bit more growth than that, probably in the low double-digit loan growth. Some of it may have to do with the economy. A lot of it has to do with being just a little more intentional as a company in the way we're attacking and serving certain industries.
Talk to me about mortgages, because we're seeing demand for mortgages pick up, yet we keep hearing that tight credit is one of the major forces holding back this housing recovery right now. What can you tell us as a bank that makes mortgages?
Yeah, well, we're certainly participating to a full extent. From a mortgage perspective, you can originate as many loans as you have people to originate, underwrite, and process them. So if the pipeline's this big, demand is that much larger. We're seeing a lot of refinance business for sure, but picking up in the way of purchasing and also construction permanent with people coming to build their homes. So far as access to those low fixed rates, there are programs in place that have begun to work this year for people who are underwater, so to speak, on their homes or have very high loan-to-values. Many of those consumers have had access to the lower fixed rates and refinancing. Those with low credit scores or those with cash flow or income that's not predictable or difficult to document, they have had a very hard time getting a mortgage, and that's not likely to change anytime soon.
I want to talk about net interest margins because they have just contracted as the Fed has continued with zero interest rate policy. So how is Sandy Spring Bank grappling with a zero interest rate world, and what is your outlook for net interest margins?
Yeah, it is. That's a very difficult situation. We'll be talking a lot about the net interest margin for probably a couple of years to come, as we, as you said, have essentially a zero rate environment. For us, we've been able to maintain our margin fairly well, certainly better than many of our peers in a couple of ways. One, we've been able to provide a value proposition for our clients and prospects with a very team-oriented, high-touch service, and being a reliable source of credit and a safe place to deposit money. In that regard, we've shown value, and our clients are willing to pay incrementally more for that in the way of interest rate and fees. We've also made a strategic acquisition this year, a bank called Commerce First out of Annapolis, which was a very good small business lender, and they had a very nice portfolio of relatively higher margin small business loans. And so we were able to bring that into our portfolio, fund them with investments that were relatively lower yielding, and pick up some basis points there. But suffice to say, for our bank and really all banks, that net interest margin will be under pressure for some time to come. Every loan that you make is at a lower rate than the one that paid off. Every investment you make in your investment portfolio, it has a lower yield. So it's going to be an issue.
Do you think that interest rates should remain at zero till at least the middle of 2015 as the Fed has projected? Is it a prudent policy now, given that, as you alluded to, those who need access to cheap credit really can't access it right now?
Yeah, well, that's the guidance that we're operating under. As far as whether it's prudent or not, I think the Fed has certainly pinned its hopes on a recovery, for a recovery in the housing market. And lower rates absolutely provide some underpinning to housing. And we've seen that. You know, home sales are up to some degree. Values seem to have a floor under them, and they're beginning to tick up, certainly in this market and in many around the country. I think from a macro perspective, for a country that is struggling to some degree to service its debt, and debt that continues to grow, rates that go up precipitously is only going to make that problem harder. On the flip side, for savers, particularly for senior clients who are now rotating out of three or 4 or 5 year CDs at 4% or 5%, they're finding rates now at 1%. And that drop in income is really significant. And I think it's causing, in some cases, seniors to burn through their savings faster than they anticipated, or take risk to chase returns that really is not prudent at this point.
Coming back to your acquisition of Commerce First Bancorp earlier this year, you do have a lot of capital on hand. You have said that you are looking to expand in Northern Virginia. Any acquisitions on tap, perhaps in the Northern Virginia market or perhaps elsewhere?
Northern Virginia is a very important market for us strategically. We made an acquisition to establish a beachhead in 2007. We've opened essentially a branch a year on a de novo basis since then. But we're not at critical mass yet. So Northern Virginia is definitely an area that we're looking to expand and to grow and to achieve that critical mass. If we can find an acquisition where it could be accretive to earnings and help the margin, I'm sure we'd be very open to it.
I want to get your sense of the Basel III capital requirements, because banks, both large and small, feel that these capital requirements are too stringent. They have said that it could cause them to cut back on lending and raise the cost of loans. As a regional bank, how do you feel about having to adhere to Basel III capital requirements?
Yeah, great question, very timely as well. The public phase of comments is over. Very unclear here to what extent Basel III will be employed for the regional and local banks. As you said, capital, if it is fully installed at that level, will be under pressure. You'll need more capital. That could impact the amount of lending that's done at the community bank level. I think certainly the cost of being in business will go up just due to the analytic requirements of compliance. And so I think for many banks that's going to be a problem. I don't think it will put community banks out of business if it's installed. It may, though, be a last straw. So for banks that already have credit problems or capital problems or are struggling with compliance or overhead, to layer that on could be a last straw.
Mr. O'Brien, thank you so much for sitting down with me today. So appreciate it.
My pleasure. Thanks.